Morning, market chameleons and soon to appear the King Chameleon, Dimitri Pargamonic. How you doing, Dima?
Good morning, Will. How are you?
Excellent. Let's jump right to the disclaimer on this wonderful Tuesday morning. There you go.
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not registered investment advisors or broker dealers. We're not telling you what to do or just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer questions and provide you with guidance. There's a disclaimer.
Excellent. Just a little heads up to everyone out there. Tonight, I am doing the second episode with Raj, one of our active Chameleon users, and he's a big influence on the Discord group, very involved in the Discord. So I'll put that link out on the chat for everyone. So it should be good.
Yep.
6 p.m. tonight.
All right. So let me share my screen here really quickly. And I think we'll just look at what's moving in pre-market hours today, take a look at what's coming up in the earnings, and if there are any questions along the way, Will, let me know. I'm going to try to answer as many questions as I can before the end of the show. So having said that, let's start with the pre-market movers. This is the pre-market report. Stocks trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. And I'm going to come down here really quickly and see that 105 stocks made our percentage gainers list, 29 on our percentage decliners list. So from that perspective, looks like a more bullish bias at the open. I'm going to come down up here and see what's going on in the higher market cap stocks. So I'm going to use market cap, 20 billion market cap or higher. So looking at percentage gainers list, I see 23 made the percentage gainers list, 7 on the percentage decliners list. So from that perspective, it looks again like a bullish bias at the open. Looking at just the higher market cap stocks, some of them I'm just scanning with my eyes that are standing out. Walmart reported earnings, so they're up 4% in the pre-market hours. So right here, Walmart up 4%, trade 914,000 shares in the pre-market hours. This little E, that's the indicator that there's earnings either today before the market open, yesterday after the market closed. So the stock's reacting to that news. There's the news headlines if you hover over that little N. So let's take I'm going to take a little closer look at Walmart. Then maybe we'll come down, see, AT&T sticking out at me on there as well. So I'll come back to AT&T. So Walmart here closed at $138.89 yesterday, trading in the pre-market hours $144.25. That's up 3.9% from yesterday's close. We see the range in the pre-market, 138.50 to 144.75. VWAP price in the pre-market, $142.94. So we're above that VWAP at this moment. This is what the pre-market chart looks like. And since I'm going to come down here, if you want to read the headline news, you could click on here. But we see that Walmart beats estimates. They reported earnings. It's up on that news. Really quickly, you have these different tabs to look at Walmart from a historical perspective, how the stock tended to behave around different events. So if it gapped up, gapped down in the morning, and here we have earnings stock patterns. So since Walmart's reacting to earnings, let's take a look at the earnings stock patterns just to get a sense of how that stock tended to behave after reporting earnings. So I'm coming down here to the data table, and here we have historical earnings dates for Walmart. And then in this table, we have a different view of Walmart, how the stock behaved heading into earnings, the day of earnings, and after earnings. So here we see before earnings, Walmart tended to have a run up in the stock. So starting 2 weeks out, 1 week out, we see 82% success rate. 2 weeks and 1 week out, stock tended to run up. Average gain 3.1%. Heading into earnings, with a 2 week horizon, 1.7%. 1 week horizon. Let's see how it tended to do day of earnings. Okay, so right now we're in the pre-market, so we want to see how it tended to open from the previous day to the next day. So we're looking at the opening gap move. Here are the different gap moves for each of these earnings. So we see that 73% of the time, Walmart tended to gap higher, 18% gap lower. At the opening, on average, gained 1.2%. That if we take a look at what is the average magnitude of the move, so if we converted all these gap moves to positive moves and took the average, on average, it moved up or down 2.4%, and this is the range as high as 6.1% and unchanged over here. So if we look at today, 3.9% to the upside, that's higher than the average, but still within our historical range of 6.1%. What did Walmart do after the opening? So we see tended to open higher after reporting earnings. After the opening, we set that to the new benchmark price to see what the stock tended to do the rest of the day from the opening price. Okay, so from the opening to the high of the day, we want to see how much did it tend to gain from that opening to the high of the day. So here we have the different percentage moves. On average, 1.9% from the open to the high. From the open to the low of the day, on average, down 1.3%. From the open to the close, so what did it tend to do from the open to the close drift? We see 73% of the time it closed lower than the opening price, 18% higher for an average loss of 0.5%. So just eyeballing the historical price return distributions heading into earnings, looks like it was stronger. Head at the open, seemed like it tended to gain. Afterwards, it looks like it weakened. Right? Look at following earnings, it looks like it tended to weaken. So it just looks like from a historical perspective, people got into the stock heading into earnings, maybe expecting good earnings, taking profits and coming out. So that's looks like that was the historical stock behavior in Walmart. If there are no questions on Walmart, I'm going to come back to that pre-market report.
No, that's fine, D.
Okay. AT&T down 6%. We're talking about it yesterday, so it sounded like they were spinning off some of their entertainment business and maybe focusing back on their telecommunications business. And from what I was reading, they're taking a big haircut on that investment. I think that they accumulated, they owned, a bunch of like news channels and HBO and all these different entertainment channels. And I think that from, I was reading estimates, they paid almost like $180 billion for these assets 3 years ago. And now they're selling them like around what they would say like theoretically is equivalent to 80 billion because of the way, they're not outright selling them. They're doing some kind of spin-off and exchange of, assets or debt. But that's a big hit, for such a large investment. And it's only like been 3 years. So maybe, when people are starting to find out about the spin-off and the terms and the haircut in that investment, down 6% in the pre-market hours. The only other one sticking out at me here, Coinbase now trading 241. That's below its initial indicated price, $250. It was indicating to open. It actually opened at 380, sold all the way back down below 250. I think they had a interview with the CEO of Coinbase or someone at these exchanges, saying that eventually they think that these exchanges will become like commoditized, because there's going to be lots of there's actually more competition on these exchanges than you have on the regulatory exchanges like NASDAQ, NYSE, CBOE, because NASDAQ, NYSE, really they have that, they're regulated, but the barriers to entry are really high for regulated exchanges, right? So Coinbase could face a lot of competition. Tesla, the other one, I know there's some news there about, what's his name, Michael Burry, the guy from The Big Short, who was like, they made a movie on Big Short, Will,
Yep.
when shorting mortgages before
Mortgage-backed securities. Yep.
Yeah, he was looking at Tesla making his case for bearish case, and I think the reports were that Tesla relies on what like credits, some kind of environmental credits that they actually then resell, because they create, environment friendly zero emission cars, that they get these credits that they could resell to other companies that don't have that, and they use those, and that's part of their profits. So eventually, if these companies start, other manufacturers start producing electric cars, they might not need to buy those credits. So he was making, some of the case for his short.
Yeah, I mean, it has, shorts have been winners for a while, depending where you got in, right?
Yeah, I think
as we were talking the other day, the stock was, in the 900s, so it's
it
lost.
was in the
almost
900s. Yeah, and it sounds like he's got a sizable short position in options. That looks like, I don't know, not very far out. I think I was reading by the first quarter, that Tesla's going to. I don't think we know like the strike price or how far he thinks it's going to go down, but obviously he's been. I think he was in GameStop too. Was he? Did he make? I think he made a bet on GameStop as well. But when he's out there, he looks deep into these stocks too, before he puts on sizable positions. So he's looking at their financials, their business models, and you got you got like Kathy Woods talking about, case for bull. Now you got the other side looking at it for a bearish, and so we'll see how it plays out. But that's been in the news. So these just going over some of the stuff that's been in the news. If there are no questions on the pre-market report, Will, I'm going to move on to the upcoming earnings.
Perfect. There were some comments by Jake entered the chat, and he says Tesla's is a credit and trading crypto platform. Cars are just secondary.
Yeah, it's like, what becomes worrisome is when you got the CEO, not talking so much about the technology, but you don't want. It's never good news yet when you're starting to see somebody use the company to trade other assets, right? Because they're not supposed to be the companies. If the company's business model is not like Goldman Sachs, where they're in the business of trading, right? So they're in the business of trading stocks. And so if you're producing cars, and if you're starting to tweet out too much about, trading and crypto, like what are your, the question is, what are you concentrating on? Are you concentrating on trading or your business? And because he's supposed to be the genius and the spokesman to educate people about Tesla products, right? So when you start talking about Bitcoin and Dogecoin, and if it becomes a little bit worrisome. So I'm going to move on to the upcoming earnings. I guess there's no other questions then on anything in the pre-market.
Nope, that's good.
All right, so let's go upcoming earnings analysis. So we're going to take a look at stocks expected to report earnings in the next 2 weeks. What I'm going to do is first use this filter here and look for stocks that trade at least 5,000 option contracts per day or more, just to get more to filter out more of the liquid stocks. And let's go to this tab here, full report. And now we have a list of stocks here expected to report earnings in the next 2 weeks. So you could see here, 47 expected to report earnings that meet this criteria, the filter. We're going to take a look at it from the perspective of how the options are being priced. So let's take a look at, I'm going to go to the more familiar names. So here's Target. So Target trades 30,968 option contracts on average per day. They're expected to report earnings tomorrow before the market opens. The option straddle here, this implied move, is coming from the option straddle. So you're buying a call, buying a put, you're paying premium and for the stock to move in either direction, up or down. So the stock has to move by a big enough percentage to cover the premium of both the call and the put, right? Because you're buying both. So that's where this implied move's coming from. It has to move by 5.5% for that option straddle to break even, okay? So for the buyer and the seller, break even 5.5%. For the buyer, it has to move more. For the seller, it has to move less. So implied move right now, 5.5%. How does this implied move compare to historical realized moves in Target? So that's the question, what happened to Target historically to the price of that stock after reported earnings? So let's take a look at first for the last 4 quarters. So if we took the average move in the last 4 quarters in Target, took the absolute average, doesn't matter up or down, just the magnitude of the move, on average moved 6.2%. Okay, so 6.2%, that was the average move in Target. In the last 12 quarters, on average moved 7.8%. So we could see here at 5.5%, we're 0.6% below the 4-quarter average, 2.3% below the 12-quarter average. The high move the stock made in the last 12 quarters after reporting earnings moved 20.4%. Okay, so that's the high move on. How does the straddle at 5.5% compare to where the straddle was priced historically? So we compared the implied move versus the actual realized moves. Now we'll compare how the options were priced versus are priced today versus how the options were priced historically. So in the last 4 quarters, on average, they were implying a move of 5.5%. In the last 4 quarters, in the last 12 quarters, 6%. So really right in line with the last 4 quarters, a little bit below the last 12 quarters. Okay, so that's in Target, a really quick view how the straddle is being priced heading into earnings. Let's do another one. Let's go to Lowe's because they're reporting both the same day. I would assume that their businesses are very similar. Do you think so or not? Or maybe Lowe's is more closer to Home Depot, I guess.
I would think they're close though.
Yeah, I would just think if people are either spending money on household, buying houses and spending money on their house. But maybe this Lowe's is closer to Home Depot than Target. But they are reporting tomorrow also before the market opens. On average, they trade 18,800 contracts per day. That straddle right now is implying a move of 5% in either direction. So how does that compare to historical moves in Lowe's? So we see here in the last 4 quarters, on average, the stock moved 3.1% in either direction. In the last 12 quarters, the stock moved on average 5.6% in either direction. So we see here, relative to the last 4 quarters, where the implied move is 2% above the 4-quarter average, and we're 0.6% below the 12-quarter average. The high move on that stock, 11.8% in the last 12 quarters. So that's target and lows. Let me see. I'm going to come down to see if there's any other. There's some bigger names, but they're a little bit further out. These are coming up tomorrow. So we got Cisco tomorrow after the market close. So let's take a look at that. Cisco trades 77,968 contracts on average per day. That straddle is implying a move of 4.5%. That compares to a 4-quarter actual realized move on average 6.3% and 12-quarter average move of 5.6%. So we see that's below both the 4-quarter and 12-quarter average, 1.8% below the 4-quarter average, 1.1% below the 12-quarter average. The high move in Cisco, 11.2% in the last 12 quarters. All right, so those are the big ones. I mean, we've got a couple other big ones in the middle, but if there are no questions, maybe what I'll do is just take one of them to kind of go and do a little bit further research.
Excellent.
Anyone in particular people like out of these? If you give me a symbol, I'll go to one of these.
Well, I'd like to see Cisco.
Cisco. All right, so let's take a look at Cisco. So here's Cisco. First, we'll take a look at the straddle. And here, this is kind of a visual of what the straddle, how the straddle was priced relative to what the actual move was. So as an example, here we see if you start out at 0%, that's unchanged, right? The brackets here are going up and down by the same distance. That's the straddle. It's implying to move up or down, right, in either direction. So I'm going to give you this as an example. February 9th, after the market closed, Cisco reported earnings. The move, they were down 2.6%. That's what that red bar is. The actual move was down 2.6% that day after reporting earnings. The implied move heading into earnings was up or down 5.6%. That's why you get the brackets up and down. So you could see here that the move was more muted than the straddle was implying, right? The straddle was implying 5.6%. The actual move was 2.6% down to the downside. On this green bar here, that's when the actual move was to the upside. So November 12th, Cisco reported earnings after the market closed. The next day was up 7.1% after reporting earnings. The straddle was implying a move of 6.4%. So you could see here that the actual move exceeded the straddle, what the straddle was implying. So if you sold that straddle, you'd have to buy back at a higher price. If you bought it, then it would have been profitable. So you could see here to the downside here that move was large compared to what the straddle was implying. So it was, more than double. The move was more than double than the straddle was implying. So let's take a look at historical stats here. We see Cisco, the straddle overestimated the move 58% of the time in the last 12 quarters. On average, the straddle was predicting a move of 5.3% in either direction compared to the actual realized move of 5.6%. So you could see here that those move on average and long term, the moves exceeded the straddle price by 0.3%, and probably this one over here put it over the top, right? Because that one was a big outsized move on August 12th. And we see here the straddle, being long the straddle, was profitable only 36% of the time. But because you got that one really big one here, on average, it would have still been a winner from the long side by 1%. Long strangle, that's when you're buying out of the money call and out of the money put. That was a winner 33% of the time for an average loss of 3%. Credit iron butterfly, winner 36% of the time for an average loss of 26%. Credit iron condor, 50-50, average loss 12%. Let's take a look at the implied volatility. So this, we just looked at it from the perspective of the implied move versus the realized move. What about the implied volatility? So we're going to take a look at a option that has 30 days to maturity. And we do that because the further out you go, the more vega is in the option. So when we look at the very near term options, those are mostly gamma. You're looking at mostly pricing in the move. The further you go out, you got more and more vega and time value. So if people who are just trying to hedge the move and looking at the implied volatility crush, will do like a calendar spread, right? You hedge the move from buying the nearest term options, sell the vega further out, hoping that after the event, everything comes in, and if it comes in line, you could profit from that vega move potentially. So what did the 30-day IV do? Historically down 29% day after reporting earnings. So one day before reporting earnings, on average, the 30-day implied volatility was 32.7. The day after, on average, fell to 23.4. 5 days later, 21.5. So you could see how that implied volatility declined after the event. If we look at the call spread, so this is if you're sold at the money near, bought at the money far, at least 14 days further out, that was a winner 42% of the time for an average loss of 5%. Same kind of in the put spread, same thing, very close. What about buying at the money near? Okay, so this is a diagonal spread. You're buying at the money near term, selling an out of the money option longer term. So think of it as a vertical spread with different expirations. Buying like, an at the money call, let's say, this expiration, then going out further and selling a higher strike out of the money call. That was a winner 58% of the time for an average gain of 2%. So the idea here is that when Cisco, with this, the idea is if Cisco reports earnings, the stock goes up and implied volatility comes in, then this would be a winner, right? Because you're doing kind of a call spread with selling more vega by going out further. Put spread, similar situation, buying at the money near, selling it out of the money far. That was a winner 50% of the time for an average gain of 17%. So you could see here how the different time spreads worked out from a historical perspective. So let me show. Does anybody want to see what this looks like from an options chain perspective?
Definitely.
All right, so let's take a look at the options chain. So so the nearest term, right, May 21st, that's going to cover this earnings May 19th. So let's say we have a little bit of a bullish bias, okay, just for this demonstration. So I'm going to buy the 53 call, $1.21. Okay, so I'm clicking on that. Hold on a second. Hold on, Mike. So that's buying the 53 call, $1.21 on May 21st expiration. And then let's say we assume that the implied volatility will come in and the stock will go up a little bit. So I'm going to let's go out to, I don't know, June 18th. It looks like there's a lot of options trading here. And let's say 53, I'll sell the 55 call. Okay. So you could see in May, I'm buying the at the money 53 call for $1.21. In June, I'm selling June 18th, I'm selling the 55 call for 83 cents. I'm going to load that strategy. So this is what it would look like, assuming on May 21st expiration, that May 21st, the first option goes to parity, and on June 18th, this is option still going to exist and we're assuming that the implied volatility is the same. So that's how the first graph looks like. But we think, what did I say, that this is going to decrease by an average 30%. So let's take this down. Let's just take this down to, I'm going to take this both down to 20 for now. Let's just say this goes down to 20. This goes down to 20. I'm going to reload the strategy. So this is what it would look like after the reported earnings, assuming at expiration. So this is assuming that implied volatilities fall down to 20. So you could see here, if the stock goes up, that's where you're starting to make profits. If the stock goes down, you're losing, but it's like a call spread where, your losses are starting to be, limited down to the downside. So that's what it looks like. So it's kind of like a call spread with extra, but selling extra Vega by going out further out. Hopefully that made sense to everybody. We're at 9:30, so I'll stop there.
Awesome job, Deem. As always, that made sense to everyone. Lots of good chat on the chat today, chameleons. Thanks for joining. Remember, webinar with Raj from the Discord group. I know we had Jake on there. With Jake, he's one of the big contributors on the Discord. Anyone who wants a link to the Discord, email me at williammcbride@gmail.com. I put that as I did the registration for tonight's webinar at 6. Thanks so much, D.
Thanks, everyone. Thanks for joining. Stay safe out there. Have a good trading day, and hope to see you guys tomorrow.